Hey, so good evening. So we just did quiz 1. Somebody left their Ernst & Young federal income tax book at the front.
I'll take it.
By the way, if you want a better book, I don't know. I know that they make you buy that one, but Bird and Chen, BYRD and Chen's a lot better reference book for the income tax system than that one. It's Bird and Chen. It's called Canadian Tax Principles. It's a really good reference for the both personal tax and corporate tax. It's my favorite. It's a lot better than that one. That one's garbage as far as I really don't like it. Okay, so tonight, well, we just did quiz 1, and then okay, so now I'm going to do chapter 11, all of it, and also I'm going to do the part of chapter 14 that was not covered in 2504. Because in 2504, hopefully, you did 14.1 to 14.4, so which was cost of equity, cost of debt, and weighted average cost of capital. Okay, quiz 2 next week. Then you get 1 week off after that. Then the midterm's the week after that. Midterm I think is October 13 or 16, something like that. So quiz 2, well, it's same time, same place, obviously. It's going to be on what I do today, chapters 11 and 14. The suggested exercises with the solutions are posted on WebCT. How many people used them to study for the first quiz? All right, so the TA didn't waste his time typing all that stuff in. The textbook, there was a mix-up with the bookstore. They didn't order the textbook, but I hear that they're ordered now. But in the meantime, I left my textbook. Hey, what are you doing here?
I just want to pick up the quiz.
All right. Hey, everybody, that's the TA. There you go.
Sorry, I just want to get my friend some pizza. Did you want to slice?
What is this? Get out of here. No, seriously. Like, I'm teaching a course here.
Oh, you want a slice?
No, I don't. Get out of here.
Only.
You're an idiot.
Oh, thank you very much, sir. I didn't say that.
Get out! Okay, so textbook is at the library. So really, the only reason to have the textbook is to have the problems at the end of the chapter, of which you have the solutions there. So you can just go. I put it, I think, for 1 hour or 2 hours, just so you can photocopy, or you can just borrow somebody else, look at the problems. The video for today is going to be available this Friday. Has anybody used I put them up on YouTube. Did anybody use that? Okay, so it worked for people? Perfect. If you ever have technical problems with some of the other things of the videos, send me an email and I'll look to fix it. Okay, so this is chapter 11. It's really 9, 10, 11 are really a block of chapters put together. And in chapter 11, what we look at are the uncertainty of cash flow estimates. Because in 9, you're just given what the cash flows are. In 10, you're taught how to figure out what the cash flows are. And then in 11, we talk about, well, those cash flows are not exact numbers. They're forecasts. So there's some uncertainty. And then we also talk about break even and operating leverage. So like I said, when you do these estimates, they are estimates. They're not audited financial statements of something that has happened in the past. They're what you think is going to happen in the future. and they're never and never exact. So where does the uncertainty comes from? Forecasting risk. How sensitive is the estimate of the net present value to what the cash flows are? So it could be, for example, that there's some variables that have a very high impact on what the actual cash flow is going to be in the end. So it could be, for example, if you're running a refinery, so the price of crude oil is obviously going to have a major impact. If it goes up by a little bit, it could mean like 100,000 up or down in your cash flows. So you want to look at all the different variables that go into making these estimates, and then you'll see in a bit, you figure out which one has the biggest impact, and those are the ones that you really want to nail down in terms of your forecast. And although we don't cover that in this course, you'll cover maybe in other courses. If it's a variable that has a very high, impact on what your profit's going to be, then sometimes what you will want to do is use derivatives like options, futures contracts, and so on. For example, if you're like a farmer and you need to buy corn, but the price of corn goes up and down like a yo-yo, and it's double or it's half, what you can do is you can enter into these derivative contracts to say lock in the price of corn for the whole season, or lock in the price of corn next year. Or say if you're selling say pork, then you might sell, enter into lock in your price so that you don't end up raising a whole bunch of, or say maybe cattle, and then the price is very low at the end of the season, and then you make a loss. So any variable that has a very high impact on what your forecast and what your net present value is going to be, this is the ones that you really want to focus on. One thing that you'll see, if you're doing business plans, like if you don't do that, you're going to look fairly incompetent. You always want to look at, well, there's one missing there, but best case, base case, or expected case, or average case, and worst case. And so for each one, what you do is you'll have a couple of variables. So, how many units am I going to sell? What price am I going to be able to sell them at? What is going to be, my cost? So what you do is you come up with a base case or an average case, which is what you expect to be, most likely what's going to happen. But then all the different variables, you all put them to the worst possible scenario, and then you re-crunch your model, and that gives you what the net present value is. You'll see examples in a second. Obviously, in the worst case, then prices are lower, quantity sold are lower, costs are higher, and so on. Sometimes students, they put everything negative or everything positive. You have to think, if it's a cost, then in the worst case it goes up, and if it's a cash inflow, then in the worst case it goes down. Vice versa for best case. So you'll see an example in a second. There you go. So here we have the quantity. Now, if it says plus or minus, the quantity says plus or minus 15, sales quantity plus or minus 15. Right now we're doing the worst case scenario. So in the worst case scenario, the quantity is going to be at the lower bound. So when you say something is minus 15%, what you do is you multiply by 1 minus the percentage. So it's this, what is that? That's 85%. So what I'm saying is, in the worst case scenario, in the average case, you would sell 54,500 units. In the worst case scenario, you would sell 15% less than that, meaning that you would sell 85% of 54,000. So that's 46,325. The price in the average case is $11.99, but in the worst case it's minus 2%, so that's going to be 1 minus 0.02, which is $11.75. So you can see that in the worst case you'll sell less units and at a lower price. The variable costs are $8.16, but because that's a cost, in the worst case your cost is going to be higher. So in that case, instead of 1 minus the percentage, because you want to have what is 10% more of 8.16, then you will multiply by 1.10. Well, it's really 1 plus 0.10, but I'm just lazy. So that's 8.976. The fixed costs are in the average case 124,600. But they're 4% worse, so they're going to be 129,584 instead. And so the operating cash flow in the worst case, I'm going to use, remember there's many different ways of calculating operating cash flow, but the tax shield method is usually the easiest to use. So that's sales minus cost, 1 minus the tax rate, plus the CCA tax shield. So that's, what are the sales? It's the price, 11.75, minus the fixed cost, the variable cost, 8.976. times the quantity, 46,325, minus the fixed costs, 129,584. So that's the pre-tax. That's your S minus C. You got to multiply by 1 minus the tax rate, which is 1 minus 0.35. And then you still have this part here, the CCA tax shield. That is not affected by what scenario you're in. The depreciation is always the same whether you're in the average case, the worst case, or the best case. And obviously the tax rate doesn't change either. So the depreciation is 228,700. It's straight line over 7 years. So 228,700 is the depreciation over the whole life of the asset or the investment. And so 228,700 divided by 7 is what the straight line depreciation per year is. And then the tax rate is and so the final answer okay, there's two types of analyses that you do. The first one is scenario analysis, where what you do is you change all the variables at one time to their worst or their best case. Sensitivity analysis is just one variable at a time. So here's an example. You know, you're running, say, I'm manufacturing bicycles. So what is going to be the change, my change in operating cash flow if rubber goes up by 10%? That's in the scenario analysis, it's basically all the variables at once. You want to see what, what's going to happen in the very worst case. Whereas in sensitivity analysis, what you want to see is how does your operating cash flow and how does your net present value change as a single variable changes back and forth. And I made that last point before. The greater the volatility in net present value to one variable, the more you really want to nail down what the forecast for that variable is. So sometimes, you might have a variable that, might be, might have quite a large forecasting error on it, but it might not have a very large effect on what your net present value is. In that case, you wouldn't spend too much effort on that. But if there's a specific variable that has a large effect on what your outcomes are going to be, then you really want to put more effort into, if possible, finding a better forecast of that variable or finding ways through derivatives contract to, bound your risk. So here's an example of sensitivity analysis. So remember that we want, in this course, you're going to hear this expression a lot, incremental cash flow, right? Not what is the overall cash flow, what is just the change in cash flow based on, some event happening. So in this case here, we want to know how does the net present value change when there's a $1 increase in the variable cost per unit. So what we're going to do, now this one here, you got to think a little bit about that. But the change in operating cash flow is going to be, remember that a way to the tax shield way of writing operating cash flow is sales minus cost, 1 minus the tax rate, plus the tax shield, which is the depreciation times the tax rate. But what you want to know is not what is the overall. You could just calculate the whole operating cash flow in the base case and then change the variable cost and then recalculate and then figure out the value. But instead what you can see is the difference is just going to be what the difference in variable cost is times whatever the quantity is times 1 minus the tax rate. Just think about it here, right? If the variable cost change, another way of writing this sales minus cost is the quantity times the price minus the variable cost minus what the fixed costs are. Because P dot Q, that's your sales, and V dot Q, that's your variable cost. So you can, I don't know if you see it, but the change in operating cash flow is just going to be whatever the change in variable cost is times what the quantity. Remember that only one, in sensitivity analysis, only one variable at a time changes. So here the quantity is fixed, and obviously the tax doesn't change. But you just want to see what is going to be the change in operating cash flow if you change the variable cost. So that's what you use there. Say if it was, say if I had, what is the change in net present value for a $1 decrease in fixed costs, then what that would be, I'll just write it down here. If I had the question, what would be the change in net present value for a $1 decrease in fixed costs? What that would be is change in operating cash flow is the change in fixed cost. That's it. Would be negative, because if the fixed costs are going up, then the cash flow is going down. So in this case, that's really just saying the change in variable cost. Right? If the variable cost per unit goes up, then the total variable costs are going to go up and the operating cash flow is going to go down. So it's going down by minus $1 per unit. And you have 10,000 units. And the tax rate's is 34%. And so the change in operating cash flow for a single year is minus 6,600. But that's not what the question. You're halfway there. What is it? What we're asked is, what is the change in the net present value? So it's not just what the change in operating cash flow for the single year is. It's what the change for the net present value of the whole project is going to be. So that's going to be the change in the present value is going to be minus 66 for the first year, plus minus 66 for the second year, for the third year, for the fourth year. So the compact way of writing this would be and that's equal to if you're not familiar with this notation with the summation sign, that's something you should learn because you're going to see it more and more often in third and fourth year. And remember that everything I write on the blackboard is posted on WebCT. Okay, so next, well, let's just finish a little bit about that. The purpose of scenario analysis is to test whether a business plan is still going to work if things don't work out in the best possible way. And in general, what you want is to at least break even in the worst case. Right? If you only have, say, if you're just breaking even on the average case, if all you have is a 50-50 chance of making a profit on a project, it's not that good of a project. Because, you could be working, super hard and just to break even or to lose money. Not a great idea. So that's the purpose of doing these worst case. And the purpose of doing the base case is to say, wow, if things go right, I'm really going to be swimming in cash. But mostly, it's the worst case scenario that's really important to figure out. Because if you just make just an average case forecast and things look good, but say you're an airline and you didn't account for the worst case scenario of, say, the price of oil doubling, and all of a sudden you're losing your shirt, and that's not good for anybody. That's an example of sensitivity analysis for our unit sales. This is, well, the last variable that we changed was, we were looking at the change in variable cost. But in that one, that's just a picture that I took from the textbook. It was, what is the net present value of the project based on how many units you sell? So in the average case, you sell 6,000 units, and that has the project has a net present value of $15,000 because there's the 1,000 there at the top. I was gonna say, wow, you sell 6,000 units just to make $15. It must be a pretty cheap product. If you sell 5,500, then the project has a net present value of minus 8,000, and if you sell 6,500, then the project has a net present value of 39,000. But in general, what I would say is, you want the worst case to be, break even or close to break even. Otherwise, you have a pretty, if you look at that picture there, you have about a third chance to lose money. And if I can teach you anything about business, is don't lose money. So you really want to know, where is your break even? The break even is the point at which above you're making money, below you're losing money, at the break even you're just breaking even. But there's three kinds of break even. The first one is accounting break even. The second one is cash break even, and the third is financial break even. I should put them in a slightly different order. Because I got a picture a little bit further. The cash break even is the lowest one. That's the one where your gross margin is just enough to cover your fixed cost. Then the next one is accounting break even. That's the one where your gross margin is enough to cover the fixed costs and the depreciation. So the first one is just you're breaking even just on cash. You're losing money on an accounting basis because you're just breaking even on cash, but then once you account for depreciation, then you have an accounting loss. So you're breaking zero cash flow, negative accounting net income. Then the next one, after accounting, is where you make enough gross margin to cover your cash costs and the depreciation. Then the next one after that, the financial break-even, is the one where you're making enough money to pay your cash cost, the depreciation, and the cost of capital for the equipment or the investment that you had for that project. If something doesn't break even on an accounting basis, then it's definitely not worth doing it. But just in general, I'm a finance guy, I'm a cash flow guy. I'm not a big fan of accounting. I think that there's cash flow is a much bigger, much more important measure of the health of a company. Like, for example, in what I do at Sunbelt, when we value a company, we don't value it based on accounting net income. We value it based on a multiple of cash flow, not a multiple of net income as defined by accounting standards. Now, this is business 101. You should be familiar with that. When you look at your costs, you have both fixed costs and variable costs. So that if you sell 0 units, then your cost will just be your fixed cost, and then as you sell more units, goes up from there. That's the variable cost per unit. Now, because this line here that starts at the origin, that's what your revenues are. If you sell 0 units, you have 0 revenue. Right? Quantity equals 0 means sales is equal to 0. But you still have to pay the fixed cost. So when you have 0 units, then your net income is minus 900. right? Because you have 0 sales and then minus 900 in cost. What happens is, so the first line here is what your sales are, so what your cash inflow is. The second one is what, from that previous slide, is the fixed cost plus the variable cost. They're always going to meet somewhere, unless the only reason that you will not have a place where they meet is if your variable cost was higher than the price that you charge on a unit. And if you're doing that, then that's a pretty stupid thing to do. Like something cost me 20 bucks and I sell it for 10, you're not going to stay in business for very long. As long as the price that you charge on a unit is less than, as long as the price that you charge on a unit is more than what the cost of that unit is, those two lines, the slope of the cost is going to be, because the slope of this line here is the price of that you're charging. The slope of that line is the price, the slope of that line is the variable cost per unit. So since the variable cost is less than the price, then that slope is lower, and obviously eventually they'll meet, and the point at which they meet is where you make exactly 0. The sales are exactly equal to the fixed cost plus the variable cost. That's called the accounting break-even. So this is just the general expression for break-even. You'll see that at the bottom here, price minus variable cost, contribution margin. It's called contribution margin because it contributes to covering your cost. But that's also, that's how it's called in this textbook, but most commonly that's usually called the gross margin, or the gross margin per unit. So the expression for accounting break-even is, at what quantity does the gross margin that you get per unit cover your fixed cost and the depreciation? If I go forward, I guess because it's in that order in the textbook, but it would make more sense to have the cash first. Because in the cash break-even, the gross margin just covers the fixed cost. And then in the accounting break-even, it covers the fixed cost and the depreciation. So the fixed costs are 266,800, and the depreciation is 480. Straight line 6 years, so 480 divided by 6 is what your depreciation per year is. And then the price is 990, and the variable cost per unit is 664. And so at 106,000 units, you break even. So I put it up there, and if you're on the video, you can just pause it and look at it for longer if you need to. So the cash break-even is where the contribution margin covers just, it doesn't cover the depreciation, it covers just the fixed costs. So depreciation is a non-cash thing. But the fixed cost, fixed cost, example of fixed cost would be your rent, the electrical bill, the heating bill, maybe your employees, if you have the same number of staff, whether you sell like 100 a day or 10 a day or whatever. So let's see an example of cash break-even. That one's quite simple. So in this case, the fixed costs are $36,000. Oh, I remember now why I picked that example. Because it's the last one said, what the selling price is and what the cost per unit is. But in that one, it says what the contribution margin. When it says the contribution margin is whatever, instead of giving you the P and the V separately, it's just giving you P minus V as a single number. So that's what that 320 is. So you break even on a cash basis at 11,250 on that example. Next, the financial break-even is it's a lot harder to understand than the other two, because instead of just this single step, put in the formula, plug in the numbers, done. In the case of financial break-even, it's a two-step process. The financial break-even is where the contribution margin covers the fixed cost and the operating cash flow that makes the net present value equal to 0. So when you do this one, first you got to find what the OCF star is, and then you can use that formula. So here's an example. So the net present value of the whole project, you don't have to write this out every time, but I just want to show you where it comes from. The net present value of the whole project is going to be minus your investment to start, so you put in 84,000, and then plus the present value of this. What you got to figure out is that. What is the OCF star? But you can't figure out the OCF star right away. What you got to do is first figure out what is the present value of the OCF. But that's pretty easy because it's just the same as your investment. Right? If I want, and this is a similar concept to the bid price thing. If I want the net present value to be equal to 0, then say the investment in this case is minus 84,000, then I need this to be equal to 84,000 to get to 0. So I know that the present value of my break-even operating cash flows is equal to 84,000. Now what I got to figure out is what is the operating cash flow each year that makes the present value equal to 84,000. So that's just you'll see in this course and in my notes or in the textbook, K or R, they're used, both. They really mean the same thing. It's just a discount rate. just sometimes, the textbook or the examples use K. Sometimes they use R, but there's no difference between one and the other. That's just the time value of money discount rate. So this is the figuring out the payment of what an annuity is. Another one, so let me do it by the formula. So that would be 84,000 So that's how you would do it using the formula, but the way that you would do it using the calculator method would be present value is 84,000, n's equal 4, interest rate equal to 15. What's the other one? Yeah, compute payment. You would still end up with the same thing. So just when you do that, that's actually the formula that the calculator is using. Okay, so now, remember that payment is what the OCF star is. So, now I know my OCF star, I can just plug in the number into the formula, so the fixed cost is 67,500. OCF star is that number 29,422, and then price is 33. So that's how you do a financial break-even. So in chapter 11, that's the most difficult. So the 11's not as difficult as 10. Because financial break-even's the toughest problem type in that chapter. So, cash flow, a lot more important than accounting. Yeah. It's the operating cash flow that makes the net present value of your project equal to 0. The star represents break-even operating cash flow. What is the operating cash flow that makes the net present value equal to 0? If a company just breaks even on an accounting basis, it means that the cash flow is just enough to cover the depreciation. If it breaks even on the accounting basis, then the net present value is, yeah?
Oh, I just had a quick question. The OCF star is basically the OCF we calculated for the bid price, for the bid price question.
Yeah, but then in the case of the bid price, you were dealing with net capital spending and change in net working capital. You're not talking about that here.
It could get more complicated.
But it's the same concept.
Yeah.
It's basically you figure out what is the present value of the series of cash flows that make you break even, and then you split them up into even chunks by using the annuity formula. So I talked about that a little bit before. The last math concept in chapter 11 is the concept of operating leverage. And what operating leverage measures, it really says, it says, what is the relationship between sales and operating cash flow? But the better way to think about operating leverage is, what is how much does your company rely on fixed costs versus variable costs? If you have very high fixed costs and very small variable costs, then a change in quantity will mean quite a bit of extra profit. Think of Microsoft, or let's say, I hate those guys. Let's think of Apple instead. You know, it costs them maybe, say, I don't know, 20, 30, 50, 100 million to make a version of the Mac operating system, right? The programming, the testing, all that kind of stuff. So for the first copy of, say, Mac OS, you know, what is it called now? Snow Leopard or I can't, Mountain Lion or something like that. The first copy that comes out, their fixed cost is, say, $100 million. The next copy is the price of a DVD, which is like, in the quantities that they buy them, probably like 1 cent, half a cent. So that's an example of a very high degree of operating leverage business model. Another one would be, say, Boeing. You know, they I think they're up to the 787 now, the Dreamliner. Cost them, I don't know how many billions of R&D to make one. So very high fixed costs, but then to make one extra, you know, they got, you know, the R&D, you know, the engineers, you know, the test models, they got to do the test flights, they got to get the plane approved, you know, all that kind of stuff. But then when they make another one, it's just buying the steel or the aluminum, you know, buying the wires, buying the tires, and, you know, paying people to put it together. So there are some business models that have very high degrees of operating leverage because a lot of their costs, it's the relationship of, do you have more of your business model in fixed costs or variable costs? If you don't know, that's, you know, kind of tying back to what we were talking about earlier when you do, you know, uncertainty analysis of, you know, what are the different variables that really affect what my outcome is going to be. If one of the variables that you're really not sure about is the quantity that you're going to sell, you're better to have a business model that's more tilted towards variable costs than fixed costs. Because say that I don't sell a lot of, you know, of units, then, you know, I would have to pay my high fixed costs or not. But if I have a business model that's more, you know, put it this way. You know, if I don't know, you know, my quantity could be, you know, say it could be 1,000 or it could be 100. I'm better to have, so this would be, say, this would be a low degree of operating leverage because it relies more on variable cost than fixed cost. And this would be a high degree of operating leverage. So you're better when you might end up having very few units. You're better to have variable costs because if you sell less units, then your costs are going to be lower. So it all depends on what the, you know, different industries and different circumstances, whether you want the setup that you want to use. I should be using. So the degree of operating leverage measures that sensitivity of your outcome, of your operating cash flow, to how much fixed costs you have. And basically what it is, it's the fixed cost divided by what the operating cash flow is. So if you have a business model that's entirely variable costs, you have no fixed costs whatsoever, then the degree of operating leverage, well, that doesn't help much, it doesn't cover it that much, but the degree of operating leverage would be 1. What does a degree of operating leverage of 1 mean? It means if your sales go up by 10%, your operating cash flow goes up by 10% and vice versa. If you have a degree of operating leverage of 2, then if your sales go up by 10%, your cash flow goes up by 20% and vice versa. So let's see an example. So that's why it's called leverage. By using more fixed costs than variable costs, then a small change in quantity sold will mean a bigger change in the operating cash flow. That's where the term operating leverage comes from. That's that leverage. It's by having more fixed costs, it's got a bigger bang on what the change in operating cash flow is as a change in quantity or a change in price. Okay, so here, well, you're not given the operating cash flow straight out, so you just have to figure it out. So the operating cash flow is going to be the project has no initial cash requirement. Otherwise, in other words, there's no investment, so there's no depreciation in that example right there. So what are your sales? 427,600 are your sales. Your variable, your fixed costs, obviously that C right there is really, you go minus C, that's really minus the fixed costs and also minus the variable costs. Minus C, it means all the costs, both fixed and variable. So here, the fixed costs are 123,500, and the variable costs are 189,700. And you need to remember that anytime operating cash flows are always after tax. Anytime you multiply something by 1 minus t, you're converting it from a pre-tax amount to an after-tax amount. So that's why you got the times 1 minus 34 here. And that gives you an operating cash flow of 75,504. So now you can just plug in the numbers into the degree of operating leverage formula, which is 1 plus the fixed costs divided by the operating cash flow. Okay, so yeah, that's all great. So what's the point of finding this number? Here's the reason why you care about knowing what a degree of operating leverage is. The way that it applies is in a situation like this. So Amy's running a project that has a degree of operating leverage of 3.2. What would happen to the operating cash flow if Amy increases the number of units sold by 2%? So if Amy sells 2% more units, remember that there's two formulas that are relevant to degree of operating leverage. That one, which is to figure out what the degree of operating leverage is, and that one, which is to say that a change in operating cash flow is the percent change in operating cash flow is the percent change in sales, but by that magnifying glass, which is the degree of operating leverage. So if the degree of operating leverage is 3.2 and the sales go up by 2%, then the operating cash flow is going to go up by 6.4%. If say the degree of operating cash flow was, the degree of operating leverage was 2, and the number of units sold went up by 2, then the operating cash flow would go up by 4%. If the degree of operating leverage was 1, units went up by 2%, then cash flow would go up by 2%. If the degree of operating leverage was 2, and the number of units went down by 2%, then the operating cash flow would go down by 4%, and so on. Right? The percent change in sales is magnified by the degree of operating leverage. When you have no fixed costs at all, then the percent change in sales is the same as the percentage change in operating cash flow. That's it for the math part of this chapter. There's a little bit of qualitative knowledge to explain to you. You'll hear when people talk about business models or just in general, a project, what the outcomes are. You'll hear that expression, it's an option play. Here's an example. Let's start with option to abandon because that's the easiest one that I can think of. Right now, the price of natural gas is extremely low. It's so low that there's, people that, got some land leases and, drill some wells, but the price of natural gas now is below what their cost for the that they could sell the natural gas at. So what do? They're not going to pump it to lose money. So they have the option to abandon or maybe to wait. Right? If say maybe you have like a 10-year lease on a piece of land that you're producing oil and gas, or a 20-year lease, and right now the price is below what your cost is, nothing's forcing you to pump the gas and lose money. You can just put it on, it's called shuttered, I think, or something. You can just, leave it on hold, either abandon it completely or just leave it on hold and then produce when the price goes back up again. That's what happened with the oil sands. When the price of oil sands are, one of the most expensive ways of getting oil. They're also like absolutely awful for the environment, but it's just because there's, instead of just drilling a hole in the earth and the liquid coming up, you're basically taking like megatons of sand and putting them through this process where you separate the oil from the sand. That takes quite a bit of energy. That's why it's actually quite bad for the environment. It's the energy that you use to separate the oil from the sand in the tar sand that creates so much greenhouse gases. So when the price of, oil sands became economic to, you could make money when the barrel of oil was at 100, but, a little while ago it started getting down to like 70, 75, 70. It almost went below 70. The cost of producing a barrel in a tar sands, I think, is around 60, 65. And so a lot of companies that were investing and that were going to launch these grandiose tar sands project, all of a sudden they said, oh, we're not going to do that anymore, or we're just going to wait. That's an expansion. That's an example of an option to abandon or to wait. An option to expand could be, let's see if I can think of one. Could somebody give me an example of one? You have a business model where if something goes well, then you could just use more of it. Yeah.
The size of the shopping mall.
Yeah, that could be, yeah.
If you have high volume, you can increase the size.
Yeah. Yeah, that gives me an idea. Where did I see? Well, some people would, kind of beat on me to say, the university is not a real business, but they sure take your money, so it is a business. But think of the library, right? We need more space, so you just put extra floors on top of it. Or it could be that there's a couple of models where you would put in your model, if something goes really, really well, we'll just do more of it. Maybe a different twist on that could be, say we're going to open a manufacturing plant, but if, our production is all sold, then what we could do is have a second shift or have a night shift. So when you would design your business plan, you would look at that in your scenarios that, and people, investors like, angel investors or venture capitalists would look at that if something goes really, really well, you have some room to, to take off even more and maybe double your capacity. So those are things that you would consider in a model. The next qualitative knowledge concept is what is called capital rationing. And there's two types. The first one is soft rationing. You would see that more in bigger companies where it's not that, say like General Electric doesn't have the money or they could not, sell new stock or raise new debt if they had a good project. It may be that they'll say, we won't spend more than $1 billion per country in capital expenditures. So sometimes what you have, if you work in a mega corporation and you're working in a certain division, you might have some positive net present value investments, but you have an artificial limit that your division's not allowed to have more than a certain number. Hard rationing is when it doesn't matter, you just can't get the money, right? Hard rationing is more a reality for smaller businesses. Because a lot of times, smaller businesses, they have, a great idea, but then they go to every bank on the street, and then they go to, venture capitalists, and everybody says no. So they might have an idea for, positive net present value project, and they did all their, their cash flow forecast, their net present value, and their, best case, worst case scenario. It looks good, but they just can't find, the project has a positive net present value, even in the worst case. They just can't get anybody to loan or to invest in them. That would be an example of hard rationing, that you just can't get the profitability index is useful when you're, really net present value and profitability index are the same thing. If, say you had a limit of a certain amount that you could invest, then what you would do is you would sort all your opportunities by descending order of net present value. Then you would pick the first one. Do I still have money left? Then you would pick the second best one. Do I still have more cash left? Then you would pick the third best one. Do I still have more cash left? No, but I have a positive present value project. Well, too bad, I don't have the cash for that. So you would just pick the highest net present value projects in descending order until you ran out of investment funds. All right, it's 8:05, so the earlier I start, the earlier we're out of here. Okay, so in chapter 14, I'm not doing all of 14 because remember that in the way that 2504 and 2505 are taught as a block is in 2504 you do all the easy stuff because it's the course that everybody has to take. But in 2505, most of you are accounting, finance, more the numbers type of specializations. So what we do is we go back, 2505, we go back into the topics, and the stuff that was a little too complicated to cover in 2504, we just go and we fill in the missing parts. And so in chapter 14, usually what we do in 2504 is we cover the first half of it. So the 14.1 is just a little bit of qualitative knowledge, but 14.2 is the cost of equity. So that's the cost of equity based on the dividend growth model and the cost of equity based on the CAPM. Then you talk about the cost of debt. Well, really, that's just a chapter 7 thing because the cost of debt is not what the coupon rate is, but it's what the market rate on the debt is, and what that is the yield to maturity. And in preferred stock, similar concept. And so you put it together into the weighted average cost of capital. So you've seen that in 2504. What I did for the reason why there's so many slides is because what I did is I pasted all my 2504 slides for those 14.2.3 and .4. I won't go through them in detail, but they're in the slides, so you can look at them on WebCT. All the examples, the notes are there. So if you're a little bit rusty for chapter 14 from taking 2504, it's a good idea to learn that, to go over. I'll go over it a little bit quickly, but mostly what I'm going to do is cover 14.5 and 14.6. So .5 is when you might have a weighted average cost of capital for the company as a whole, but you'll have either a project or maybe a division of the company that has a different risk level than the overall company. And so when you do your capital budgeting for that project or for that division, applying the overall weighted average cost of capital of the company is not appropriate because the risk might be different. An example would be, one of the best examples, say, would be Petro-Canada, right? They have two very different business lines. They have, drilling in like the high, North Atlantic, and that could be quite challenging, 50-foot seas, and it's like, minus 20 and all that, versus, selling gas on the street corner. That's a pretty low risk, low risk business model because people always need fuel for their car, and it's pretty expensive and almost impossible to get permits, to set up a new gas station. So that when you have a gas station on a corner, it's quite a low volatility, low risk business because people always need fuel for their car, and it's hard for a new competitor to come in because usually cities don't want so many gas stations all over the place because there's risks of pollution and so on. But if you compare, Petro-Canada is going to drill a hole in the middle of the North Atlantic and spend maybe 10, 15, 20 million to drill that hole, and maybe they hit oil, maybe they don't. So that's a much higher risk business model. So if you look at when you plan these capital expenditures, you want to look at if you have a division or a project that has a very different risk. Well, first let me just review the first half of 14. But this is stuff that you should know. I'll just go through it pretty quickly. For the cost of equity, you can use the dividend growth model, which is based on having what the dividend payments are, and then discounting those at a required rate of return, or having the CAPM, capital asset pricing model, which is based on the beta of your stock and the risk-free rate and the equity risk premium. The challenge with the CAPM is that it only applies to publicly traded companies. If you're a private company, you don't have a beta. Because the way to calculate a beta for a company is to do a regression of the company's stock price against a stock index. But if your company is not public, if your stock is not traded, there's no direct way to find a beta. You can find these like kind of, indirect way, like, compare that, I'm a private company, but there's a public company that's in the same industry, and I'm going to use that beta. But it's not quite accurate because you're not directly computing the beta for your company. You're just finding it using some kind of proxy method. So when it comes to private company, did you have a question?
Yeah, do you think CAPM is for private?
CAPM is only good for public because in the CAPM formula, you have the beta. And you can only come up with a beta for a public company. Like I was explaining, you can come up with a beta for a private company, but in a roundabout way, and there's obviously large errors because you're just kind of saying, say for example, like I'm like played again in sports, and I sell like sporting goods, but I'm pretty sure Play Again Sports is not a public company. But I want to come up with a beta. Well, I could say, well, I'm kind of like Canadian Tire, so I'm going to take the, use the beta for Canadian Tire. But obviously, that's just fairly high, fairly inaccurate way of doing it. It's just, coming up with a beta as an estimate of something that's kind of like you. But so the dividend growth model, the cost of equity is composed of the dividend yield and the capital gains. And there's an important point of that formula here, in that the rise in stock price, when things are based on fundamental value, of course, real stock markets go crazy all the time. They go way too high and then way too low. They very rarely are they exactly at what the fundamental value from the theory is. Either they're way more .com way too high, or sometimes it goes the other way. After a crash, sometimes things are trading for a lot less than they're fundamentally worth. But the key point of this formula here is that the rise in stock price, the rise in a stock should be equal to the rise in the dividends. So if the dividend goes up by 10%, then the stock price should go up by 10%. That's an important point. Obviously, stock prices go up and down, above that fundamental value and below that fundamental value. Typically, what smart traders do is they short when it's above that and they buy when it's below that. So that's just a way of applying the dividend growth model. That's chapter 8. That's the CAPM. So here's an example of applying the CAPM. You got to have a beta. Finding the cost of debt is based on the yield to maturity. So you can review your chapter 7 if you don't remember what that is. So here's an example of how to do it. Remember that if you have semi-annual coupons and you have a 25-year bond, then you really have 50 periods. So instead, when you say there's a 25-year bond, but it pays interest, you got a semi-annual coupon, you really have 56-month periods. So if the coupon rate is 9, then and the par is 1,000, then the coupon payment over the whole year is 90, but it's 45 every 6 months, and there's 50 periods of 6 months, and you receive 1,000 at the end. It's currently trading at 908. So the 5% is what the period rate is, but then you need to multiply by 2 to get what the yield to maturity over the whole year. Cost of preferred stock is just a matter of the dividend divided by the price. So here's an example. If you have, if the dividend is $3 and the current price is 25, then that means that the yield, the current yield on the pref share is 12%. So what you do is you take, a company can finance itself with some equity, some debt. Prefers are a lot more rare because typically for public companies you don't have preferred. The only public companies that tend to have preferreds are banks, financial sector companies. It's very rare to see a non-financial corporation to have publicly traded preferred shares. Preferred shares are a lot more used in private finance, but we don't really cover that much in this course. It's too bad because that's what I do at work. So, and then the debt, remember that the dividend payments, you don't get to deduct that from your taxable income, but the interest payments you do. So the actual cost of the debt is the after-tax cost. So remember, when you take something and you multiply it by 1 minus t, you convert it from a pre-tax to an after-tax. So by saying RD, that's the pre-tax cost of debt, the yield to maturity, and RD times 1 minus t is the after-tax cost of debt, and that's what you use. Now, you don't just use a regular average, because if you say you had something that was 10% equity and 90% debt, it wouldn't make sense to say, 1 plus the other divided by 2. So what you do is what's called a weighted average. So the weights are based on the market value, not the book value. And so here's the weight, the E is the number of shares times the price per share. So that's the market value of equity. B is the market value of debt. And P is the market value of preferred. And V, which is market value of the firm, but that's what it's called in this textbook. But usually in finance, that's what's called enterprise value. So enterprise value would be the market value of the equity plus the market value of the debt, plus the market value of prefs if they're there. So if you want to know the weight of each one, you just divide the market value of that part of the capital structure divided by the enterprise value as a whole. So here's an example where you have market value is 500 and the market value of debt is 475. So the total enterprise value is 975. And therefore the weight of equity is 51 and the weight of debt is 48. Anytime you do these kinds of weights, an important check to do is that they sum up to 1. If your weights don't sum up to 1, you made a mistake somewhere. I'll do this example because it's just illustrates. So it doesn't take very long to do. So the enterprise value is going to be the equity plus the debt, but there's two. It's not just. So the whole debt is really just two debt. There's two bond issues. So the market value of the equity is going to be 14.2 million shares. And the price is 35 a share. And then one bond issue is 500 million. But that's the book value. Right now it's trading. Remember that when we do average cost of capital, we want to do it based on market value, not book value. So it's going to trade at 102 above that. And then the other one has 175 million of book value, but it's trading right now at 850, and it has a par of 1,000. So it's trading at 85% of its book value. So here, the market value of the bond issue 2 is 85% of 175. And so the overall enterprise value is 1.15 billion. Yep.
Why did you divide 850 by 1,000?
Because right now they're trading at 850 per bond, but the par value of a bond by default is 1,000. So the the book value is 175, but the market value is only 85% of that. It's 850 divided by 1,000. Okay. Now here's a formula that it's not in the textbook. It's just something that I came up by myself to help you guys and girls. Sorry. You'll see a lot of stuff that we do here. A lot of the formulas, either you need a weight of equity or sometimes you have a debt to equity ratio. Those are two different ways of expressing the same thing. But sometimes in the formula, you need a weight of equity, but you're given a debt to equity ratio. Here's an example of that a little bit later. So I could say that, I could have the weights, the different market value, or figure out the weights. Or the reason why the debt to equity ratio is used more commonly is instead of giving you all the weights, you just give a single number, and that describes the capital structure. So if you have a debt to equity of 0, that means that you have no debt, so that's 100% equity, 0% debt. If you have a debt to equity of 1, you have one part of debt for one part of equity, meaning that you're half debt, half equity. If, say, you have a debt to equity ratio of 3, then you have 3 parts of equity meaning that the weight of debt is 75% and the weight of equity is 25%. So that's a way to express a capital structure one way or the other. That formula that I came up with, it's not like a crazy invention, but it's very convenient. Because if you have a situation where you're given the debt to equity ratio, but you need to use the weight of equity in the formula, then all you got to do in that case, the debt to equity ratio is 0.25, meaning that the weight of equity is 80. That's just, this formula is quite useful to convert between the two. Now that's an example of doing average cost of capital. I won't go through the details. If you don't remember that, you can just look it over by yourself. I want to get to the original material. So in 14.5, what we're looking at is, like I was explaining in the intro of the chapter, what we're looking at is a situation where the discount rate that we need to use in a certain division or for a certain project is different than the overall company as a whole. I gave you a couple of examples. Could be that you have, a company that has quite different types of operations. You need to have different discount rates because you have different level of risks. If you use the wrong discount rate, if you have a project that's very risky, but you discount it, say, that really has a risk of, that would normally have a required return of 20%, but you discount it at 10%, then what happens is you end up with a project which should be rejected, but you end up accepting. If you discount a high risk cash flow at too low a discount rate, what you're going to end up with is a positive net present value when you really should have got a negative net present value. So that's a bad thing. Remember that the whole point of doing capital budgeting is to do positive net present value investment to grow the equity of the firm. So how do you figure out the the return to use for a specific division? Here's what's going on here. You have, well, this is where you have a division which has a lower cost of, a lower risk. The overall company has a cost of equity of 14.8% and a beta of 1.4. But you have a division which is lower risk. Remember that beta is also a measure of risk, so that if you have a higher beta, this is something that's riskier. But in this case, the overall company beta is 1.4, but the division inside that we're looking at is 1.3. So what you expect is not to use the same cost of equity because you have a lower risk division, so you should be using a lower discount rate, right? You have a beta of 1.3 versus 1.4, so you expect the cost of equity for that division to be lower than 14.8. If the opposite was true, and the overall company had a beta of 1.4, but you had a high-risk division, say, that had a beta of, say, 2 or 2.5, then 14.8 would not be the correct cost of equity to use for that division. You would have to use a higher discount rate. So let me show you how you figure out this one. There's a little bit of math involved. Okay, so the cost of equity. Now, do people, is that fine if I use it there, or do you have like a bad, if you're standing there, do you miss? Yeah. Yeah, I gotta get a little bit more. You find like that? So this is the equation for the CAPM. So this is for the overall company. So we want to you can rewrite this as the equity risk premium is the spread of the cost of equity above the risk-free rate divided by the beta. See, all I did here is I took the RF, put it on that side, and then I divided by DE, and I was left with RM minus RF is equal to RE minus RF divided by beta. So I have an expression for that is called the equity risk premium. Now, for a I just called the division X. I don't want to use RD because then you might confuse it with the cost of debt. You know, R for division. I just use RX for the cost of capital for that division. So the cost of capital for that division is so before, this is basically the CAPM if you write it for that division. The cost of equity for that division is the risk-free rate plus beta of that division times the equity risk premium. But up there, you're given the risk-free rate, you're given the beta of the division, you also have that, but you don't know what this is. So what you do is you use this is one of those like, two-step problems. You use the data from the one up there to figure out what this is. So you can rewrite this part here as remember that Rm minus Rf is equal to that. But really, if you just look at it this way, it's just the risk-free rate plus the ratio of the beta of the division divided by the overall beta times what the company premium above the risk-free rate is. So this is Rm minus Rf is the market risk premium, and Re minus Rf is the company-specific premium above the risk-free rate. So in this case, the risk-free rate is 3.5%. And you can see that since the beta of that division is 1.3 instead of the overall beta, the company's 1.4, that number here is going to be a number less than 1. So it's going to reduce the company premium above the risk-free rate. So the cost of equity for the overall company is 14.8. The risk-free rate is 3.5. Remember that in finance, what matters most is not so much what a certain percentage is, but what a spread of that percentage to something else is. Just like what's happening in Europe right now. It's not whatever the price of the bonds in Italy are. It's the fact that they're 5% more than what they are in Germany. Or it's the fact that the bonds in Spain are 7.5% more than what they are in Germany. It's not so much the actual percentage that matters, but it's usually the spread above some kind of benchmark. So in this case, then you just punch that through and you end up with so you can see that by the risk of the division being 1.3 as measured by beta instead of 1.4, the discount rate for that division is going to be 13.99 instead of 14.8. If the beta of that division was higher, say 1.7, then you would have gotten a number above 14 instead. Because say if it was like, say if it was 2.8, then what it would have been would be 2 times the company risk premium above the risk-free rate. So what's the problem with using the same weighted average cost of capital for all the projects? The average cost of capital for the whole, so the average cost of capital for the company as a whole is 15%. So based on that, you would accept A, and based on that, you would accept A and B. But if you account for the required return for that's different, A is riskier than the company. So whatever's going on in A is higher risk than what's going on in the company as a whole. What's going on in project B is the same as what's going on in the company in terms of risk. And what's going on in project C is lower risk. Remember, lower percentage means lower risk. So what happens? If you use the overall cost of capital to pick projects, you would pick A and B. But that's a mistake, because if you use the proper discount rate, which is 20% for A, that project's returning 17, but the required return given the higher risk is 20. So even though you would have picked that project because 17 is higher than 15, in reality, that would have ended up, you would have ended up by mistake choosing a negative net present value project. So you got to use the right metric to pick the project, and that's the required return based on the risk of that specific division. If you have a company that has something that's a lot more risky, has a part of the company that's a lot more risky, then when you evaluate the investments in that division, you got to use a higher percentage, a higher discount rate to account for the higher risk of that operation. So how do you figure out, now the challenge is, how do you figure out what a discount rate for a specific division is? Well, one approach is what's called the pure play. What you do, maybe you have a company that does many things, but you want to figure out what is the appropriate discount rate for a certain division. So what you do is you go out and you try to figure out a publicly traded company that does just what that division is doing. So here's the example. Delta Co. owns retail stores that sell building supplies. Largo builds family homes. Delta has a beta of 1.22, which is lower risk than Largo. The risk-free rate's 4, market risk premium is 6.5. If Delta wanted to get into the building houses business, it would not use its beta of 1.2 because selling building supplies is less risky than building a house and then maybe somebody buys it or not, or you don't really know the price that you'll be able to get in advance. So if Delta was considering, evaluating the project of building houses, they would not use their overall cost of capital based on a beta of 1.22. They would use the pure play Largo as a proxy for the beta that they should use for that division or that project, which is 1.34. So in this case, it's just a matter of using the CAPM, but using the pure play risk-free rate's 4%. The beta, as measured using the pure play approach, is 1.34, and the market risk premium or equity risk premium is 6.5. So that gives you so if Delta was wanted a discount rate to use for their capital budgeting project, they would use 12.71. Another way is to use the subjective approach. So if the project's more risky, you bump up the percentage. If the project is less risky, you bump down the percentage from what the overall company is. So that, here's the example. If you have a project or a division that has the same risk as the overall firm, then you would just use the overall cost of capital. But if, say something you have something that's higher risk, you would just say, I'm just going to use my average cost of capital plus 5. You have something that's very risky, I'll use my average cost of capital plus 10. If If I have something that's less risky, I'll use my average cost of capital minus 3 or 5 or 8 or whatever. So that's what a subjective approach is. And so that's just there's not really an example to show you there. It's just, if something's riskier, or you just use a higher discount rate, you just take whatever your WACC is and you add a couple points if it's riskier, and you reduce by a couple points if it's less riskier than the overall company. So next, got to talk about the average flotation cost. And what that is whenever it's not cheap to, it's a great thing if you're able to, as a company, access the public markets for your financing. A lot of people, I know for myself at Sunbelt, I'd love to, do an IPO and bring in a couple $1,000,000 and use that to grow the business. But it's, you got to be a fairly mature company, fairly well, a fairly big company to be able to access the public markets, and it's extremely expensive. Less expensive for debt, but more expensive for equity. It's cheaper to sell bonds on the public market, to do a bond offering, than it is to do an equity offering. To do an IPO offering is something like some on the order of like $250,000 to $1 million in just fees. Like investment banking fees, underwriting spread that we'll cover in chapter 15. Audited statements, the writing the prospectus, legal fees, this and that. There's, when you need capital, you do your capital budgeting analysis. It's like, wow, we got a great investment. We need to get capital somewhere. Well, you could use banks and retained earnings, stuff like that. But if you need to go to the public markets to get that capital, it's going to cost you. What that cost is, it's called the flotation cost. So let's look at an example. It's going to make more sense. The flotation costs there are 8% for common stock, 9% for preferred stock, and 4% for debt. Meaning that if I raise, say, $100 million worth of debt, then it's going to cost me $4 million in bankers' fee, investment banking fees, legal fees, accounting fees, all that. So if I need to have $100 million worth of capital, I can't sell $100 million worth of bonds, because after I do that, I'm only going to be left with $96 million. But I need $100 million to make my investment, so I'm short on cash. So the flotation costs are, you raise a little bit more, and then that's what you use to pay all the fees for, and those fees are called flotation costs. They're what you pay to get the money from the public markets. So in the case of common stock, it's 8%. So that means that if you wanted, like I said, if you wanted 10 million, or if you wanted 100 million, you could not just sell $100 million worth of stock. You would have to sell whatever amount that once you take 8% from, you're left with 100 million. It's not quite 8%. It's not that you need to raise 108%. It's whatever number you need to raise so that that number minus 8% is 100. You'll see an example in a sec. Okay, so for weighted the same way that you have the equation for average cost of capital, where you have the weights are the same. The only difference between weighted average flotation cost and weighted average cost of capital is that you don't have the after-tax adjustment factor there. The average flotation cost is how much equity you're raising times what your flotation cost on that equity is, plus whatever the weight of the preferreds are, times the flotation cost on the preferreds, and so on. So it's just a matter of plugging in the numbers. So flotation cost average is weight of equity times flotation cost of equity plus weight of preferred times flotation cost of preferred plus weight of debt times flotation cost of debt. So you got you got 45% in equity, 15% in preferreds, and 40% in debt. You're 8% on the flotation cost for common, 9% for the flotation cost on prefs, and 4% for the flotation cost on debt, meaning that your flotation costs to raise money are 6.55%. Why do you need to know this number? Here's the reason. If you want to raise, if you have a certain project cost, if you have a certain amount of capital that you need, and you have a flotation cost, then what you need to do is raise more in order to still have the capital that you need after you've paid your flotation costs. And it's not just, if say the flotation costs are 10%, to just take the capital multiplied by 10%, because what you want is whatever amount extra amount that you need to raise minus 10% is equal to what you need. So a common mistake that people do is in something like this. Well, first, I just got to there. So the weight of equity here is 60% equity, 40% debt, 8% flotation costs for equity, and 2.5% for debt, meaning that the average flotation cost is 5.8. So it's not, the right way to do it is not this. It's not to say 165 million times 1.0580. That's not how you do it. A lot of people do it that way. I see that mistake all the time. What you want is so if you need 165 million, then you need to raise 175.15. And if you take 5.8% of 175.15, whatever that number is, you subtract it, you'll see that you end up at 165. So make sure you don't do it the opposite way, because that's the wrong way. Okay, that's the last example for today. Why do you need to do this? Well, here's a great example right here. You have the net present value of the project is, without the flotation cost, is 40,105. So the future cash flows, remember that net present value is called net because it's the present value of the inflows minus the present value of the outflows. So the present value of the inflows is 1,040,105. The present value of the outflow, just a $1 million investment. So if you don't consider what it's going to cost you to go get that, to go raise that million, what you're going to have to pay bankers and accountants and lawyers to get that million, then that project would say, yes, it's a great idea. It's got a $40,000 net present value. But once you account for the fact that it's going to cost you 5% to raise equity and in flotation costs, and it's going to, your flotation costs on debt is 3%, so that the average flotation cost is 4.25%. So to get $1 million to invest, it's going to cost you, you're going to need to raise $1,044,000. So your fees are going to be, your flotation fees are going to be $44,386. So after you pay the bankers, the lawyers, the accountants, you're left with $1 million, but you raised $1,044,000. So the net present value of the project, once you include the flotation cost, which you need to incur because you're not going to get the money to invest in that project, once you account for the flotation cost, now you have a negative net present value project. So that's why dealing with those flotation costs is important, because once you include in the cost of the project what it's going to cost you to go get the capital to invest, sometimes the net present value is negative. All right, so that's it for today. Remember, quiz 2 beginning in next class.